Now for more on the markets in the third quarter ahead, Megan Horneman, Verdence Capital Advisors, Chief Investment Officer. We've been asking similar questions to people that do this for a living. Megan, 15% in the first half after 24% in the S&P last year. Those are pretty good numbers. I mean, no one ever went broke taking a profit, did they?
No. I think that right now the market's sitting at this record high, and going into the second half of this year, it's a little bit concerning to me that they're not looking at any of the downside risks that we may see. The market's focusing on upside risks, and the market's focusing on what they want to see, which is that the Fed's going to come in and cut interest rates in September. I don't think that's something that we should bank on at this point. The Fed's made it very clear they don't have to be quick to cut interest rates. And then I think from an economic standpoint, we saw it with some of the data today, and we are starting to see some weakness in the labor market. That was one of the last dominoes that were standing from an economic standpoint.
Is there just so much, trillions and trillions on the sideline that people have not deployed because they haven't trusted this market? Is that a good sign? Is it true? And is it a good sign?
Was the trillions of dollars on the sideline because they're worried about the market, or because they're earning 5 to 5.5% on their money? And we haven't seen that in so long. I think a lot of it has to do with you're earning a significant amount of interest on your money. So why take the risk when the risks are, in our opinion, so many to the downside? Let's not forget we've got a lot of election risks coming up in the second half of this year. We have earnings that, in our opinion, just still seem too unrealistic for this year and next year. And we haven't seen anybody budge that. But yet everybody's talking about how the economy is going to slow. But earnings are going to be 10 to 15% on the upside. So I think once you start to see that earnings revisions coming down, that's when I think it's going to take the wind out of the sails of this market.
What does the election risk look like, Megan? Is it uncertainty? Is that all you need to say? Or do you want to even be more specific? We did have, I thought Lonsdale Sorkin that was on, he was talking about either unrealized capital gain taxes or long-term capital gain. He said both would be really hard on entrepreneurs and innovators, if you recall. He said that it could do that. So when you say election risk, what kind of election risk? Other people think, the end of democracy if Donald Trump is elected, that could be a problem for the markets too. Maybe so. I don't know. What type of election risks are you referring to?
I think you kind of hit it there. I think there's a lot around the taxes, a lot around the uncertainty, depending on, if President Trump comes into office, what does that mean for the Federal Reserve? But our biggest concern on the, uncertainty is what are any of these politicians going to discuss about the unbelievable and unsustainable path of debt that we have in this country that's going to have to be addressed. I don't know how. I don't know exactly when, but that I think can cause a lot of volatility, not just around the election, but into 2025.
Right, and I think the solutions are kind of, they're mutually exclusive. One would be try to grow with a vibrant private sector, lower taxes. The other would be try to raise more revenue from higher taxes. So it is very difficult to try to decide what's more market friendly. And then you got unsustainable entitlements that something has to be done. That might be easier to fix if we just accept that something needs to be done, but neither party wants to touch that third rail.
Yeah, and the unfortunate thing right now is I don't know what the solution is. I'm not a politician, obviously, but I do know that we have to be very careful because we're walking a fine line. We haven't been in this situation from an inflation standpoint that we have, the inflation, it's coming down, it's getting better, but there is still sticky inflation. So if you do things to promote growth, what happens to inflation there? We're running a deficit of roughly 7% of GDP. In the past, we haven't seen that. So it's a difficult situation.
Okay, Megan, thank you.